Yo, what's up, guys? It's your boy Looney, and today I want to talk about what I think is one of the most overlooked metrics in every single portfolio. And it's not your PE ratio, not your portfolio return, and not even your win rate. It's actually the VIX, or also known as the volatility index. Now, before we get into it, quick shout out to the Discord. It is free to join, and I also offer a premium membership for $8 a month with trade callouts, my full option selling course, one-on-one coaching, giveaways, and more. All the links are in the description. Now, what is the VIX? So let me actually pull it up. And if you're not familiar, the VIX measures expected volatility in the market over the next 30 days. And some actually look at it like the fear meter. It's pretty close to that, and I'll show you exactly why, but I wouldn't only have it known as that. It's more of the volatility or the uncertainty in the market. And when investors are scared, volatility often spikes. And then with that, the VIX shoots up. And when everyone's calm, it stays low. Now, it's pretty interesting. Recently, we did see the VIX increasing as the market was going up, and that is a pretty rare scenario. And that can mean that there is a preparation to a VIX spike, maybe some FOMO is going in, but it's probably one of the two. It is worth noting that the VIX was actually climbing as the market was climbing as well. But the other interesting part is most people look at stock prices, but ignoring the VIX means you're ignoring the psychology of the entire market. And that's where opportunity often hides. And let's actually look at the history of the VIX and sort of how much it's been helpful in the past. Because over the past 30 years, the VIX has actually averaged around 19.5. And it actually spends most of its time between 12 and 25. Meaning most days markets are actually pretty chill for the most part. Yes, we do see some spikes, but you can see here, for the most part, it stays in that $25 to $12 range. And you can make money doing it in that. You can also make money in when it spikes. Because when the VIX spikes above 30, that's usually when opportunity shows up. So let's say we're going back to the 1990s. As far back as there, the VIX has only been above 30 about 13% of the time. And even the Robinhood chart only goes back to 2002. And we can see that it is very rare that it goes above that 30 range. And this is often the best opportunity. Because when it does, it tends to stay elevated for just a few weeks before markets actually start to rebound. So historically, buying during VIX periods when fear is spiking has been one of the best long-term strategies. Additionally, that's when premiums are juiciest for selling options and when stocks are trading at discounts. So how do I personally use it? Because this is not the only metric I use, but I am looking at it constantly to see where premiums are lining up and the overall fear is looking like in the market. Because I usually use it for my cash allocation. I actually learned this from Ryan. He's another investor, another YouTuber, and he has grown his portfolio pretty massively. And he as well does his cash allocation based on the VIX. Because when the VIX is below 15, it usually means the market is calm. And sometimes it could actually mean that it's a little too calm. And that's where it gets a little concerning. And that's when I like to hold more cash or scale back on my position size because the reward to risk ratio isn't as strong. And this is actually a great thing to bring up because this past week, the VIX was pretty low. Let's actually go back to the VIX. Despite it was climbing, to many that was kind of signaling that there was preparation for a VIX spike. Maybe some people were loading up on options, protective puts, or just overall increased fear. And yes, so the past week, it was sort of down. It was under 16. It was slowly climbing. And then we did see that Friday when Trump made that announcement with China, that massive spike. It jumped almost 30%, or it did jump 30% in just one day, going all the way up to 21, or I believe 20, let's see how high it went, 22. And this is when I took advantage of it. That Friday is when I actually dove into some option selling strategies. I even bought some stocks. And now we can see today that it is down. It is down 12%. And that's actually a good thing as a buyer. And today I'm actually up. I'm up 1,900. And partially because I was able to capitalize on that opportunity that we saw last week. A lot of people were saying that it's not a crash and there's more to come. But I saw the VIX. I saw the VIX spike. And although that might be true, there could be more downside. There is that overall jump in VIX really stood out to me. And that kind of showed that there was an opportunity right there. And I didn't go all in, but I did deploy some cash by buying some stock or selling some options. Because when the VIX actually hits 25, 30 or higher, and that is kind of where I start to go more heavy in. Again, I sell more puts and I add to my favorite names. And I also just take advantage of the fear premium. So basically, when everyone else is panicking, I'm looking for entries. Now, the goal of mine isn't to time the bottom perfectly. It's actually to let volatility guide my behavior and not my emotion. Okay, now we're going to go over the seasonality of things, because in April, we did see a massive drop in my portfolio along with others due to the tariffs. And if we go back to VIX as well, or let's go back to the year-to-date chart, it had a massive spike in April, again showing a massive opportunity to invest. And that's the cool part about VIX. Not only is it affected by news, it actually has seasonal patterns. And if you look over the past 20 years, volatility tends to spike most often in August, September, and October. And right now we are in October, where there is usually the most volatility, or one of the most volatility. And that creates opportunity. Now, I wouldn't be going leverage, and that's how a lot of people in the crypto space did get wiped out, is due to leverage, but I would be paying attention to it, and I'll scale in if I see some opportunity. And again, another thing, March, there is some slightly VIX spiking there. And I don't know if the VIX that happened this year in April was seasonality or just due to the fact of the news. It was probably just a combination of both. But these periods usually line up, the August, September, and October, line up with earnings cycles, political headlines, or just overall federal decisions with Fed rate cuts. And that's how we often see those mini crash moments late in the year. And yes, it is combined with news. It's kind of a spiraling effect when it comes to volatility. So if you combine this with a long-term mindset, you could literally plan your cash deployment around seasonality. And when fear is most common, that's when I start looking for those deals. And that's exactly what I did. So if we go to my options, I opened up a few trades. I had a Webull trade, I have an open trade, and I have another trade that I opened, ABTC. And this one is slightly green today, but overall still red. We'll see where this one ends up. Try to sell it at a good amount. You can see the premium is pretty big at $75. And I did it on that day that was a lot of volatility. And I took advantage of that volatility spike. So what is the takeaway of all this? And that is most investors obsess over price and just overall ignore volatility. And we can see right now that is happening. Everyone is telling you to invest into every single stock, to run in, to rush in, but no one's really paying attention to the fact that the entire market is elevated. And when the tide rises, all the boats are often taken with it. And that's why I look at the VIX. I'm not rushing in to get into positions. I'm being very strategic. But the VIX does tell you how emotionally stretched the market is. Lower VIX equals overconfidence, and higher VIX often is perceived as opportunity. So instead of asking, is the market too high or too low, you could actually ask, how fearful is everyone else right now? Because if the VIX is spiking, chances are your long-term entries are near. So here's my rule of thumb for cash allocation and the VIX numbers. If VIX is under 15, I do hold more cash. And when VIX is at the 20 or 25, I like to be balanced and stay invested. I'm always invested even when it's under 15, but I'm more cautious when it's under 15. Now, when the VIX is above 30, this is when I start buying calls, I start buying stock or selling puts aggressively on stocks that I want to own. And volatility isn't something to fear. It's actually something to use. And once you learn to read it, you'll stop reacting to red days and start taking advantage of them. Until next time, peace.